Joining us now for Metro Mining, we have Simon Wensley. And Simon, it's a timely video. You've just released your quarterly results, so tell us what have been the highlights for Q3.
Great, thank you very much. And look, it's been a very solid Q3. I was happy to report that we had another record production quarter, 2.25 million tonnes. So yeah, we've been continuing to ramp up the operation after the expansion that was implemented last year. So that was excellent, excellent results. And I think going with that, as we saw, we've been predicting, and as we've seen in the past, that extra scale does reduce our costs. So again, we saw a reduction in our costs from $31 per wet metric ton onto the ship in Q2 to $26. So a significant reduction in costs as well. We're coming with that scale. So, and that's I think we're going to see more of that moving forward. So look, I think those are the real highlights of the quarter.
Absolutely sparkly highlights at that. Now, you have been in production for a few years from your Bauxite Hills Mine in Far North Queensland. Can you tell us at this stage in the game, what is that contract mix looking like, and how does that feed into these results?
Yeah, great question. Look, we have most of our contracts are signed against the market, basically a market situation. So we contract forward 3 months, so a quarterly production, a quarterly sales price that gets negotiated 1 month in advance. But back in 2022, when we sought lending for the expansion project, so we went out and got $30 million to underpin the expansion project. The lenders were looking for some kind of certainty moving forward with the sales. So we signed at that point some fixed price contracts, about 3 million tonnes of fixed price contracts in 2022. Now that did come with some flexibility for us to deliver those contracts over the following few years as the expansion ramps up, and we've tried to take advantage of that flexibility. Of course, the price has risen substantially since 2022, so those fixed price contracts are obviously lower price than the prevailing market price, and we've been trying to manage the timing of those contracts in line with when our economies of scale and costs are lower, and also trying to make sure that when prices are high, we're maximizing the amount of market-based contracts. So there was a reduction in our sort of blended average price from Q1. So and that resulted in a margin drop from around about $32 per ton down to $16 a ton, because about 40% of our sales in the last quarter were into those lower priced fixed contracts that were signed in 2022. Now, if you readjust for those sales, so if we had sold all of our contracts against the prevailing market price in the last quarter, our margins would have actually been very similar to the Q2 number. So as I said, we delivered a margin of $32 per ton in Q2, and if we had readjusted, that would have been more like $28 a ton. So it was, and I think that's again, it's a good portent for for the future. I mean, once these legacy contracts have been finished, so we're planning to sell the remainder of all of those contracts in this current quarter. So another roughly about 40% of our volume, or around 900,000 tonnes, will be sold into those legacy contracts. But once that's done, once we get through that quarter, then they're all done. So no more legacy. And then so in 2026, we'll be fully exposed to market. And so that margin of, roughly $30 a ton, I think is that, internally we're using that as a certain kind of average target going forward. And you can see, even with prices coming down from Q2 to Q3 this year, we've been able to maintain roughly that margin. So I think, that's sort of showing really the cash generation potential of what the Metro Mining Bauxite Hills operation can deliver.
So we're staring down the barrel of a new era. Can you tell us what is next for Metro Mining and more broadly for global bauxite markets?
Well, in terms of the operation, look, we want to generate as much cash as possible out of this operation. As I said, that margin, really gives us that opportunity. We're also paying down debt now. So the debt that we took out for the expansion started to amortize last quarter. We'll roughly pay off about $12 million Australian of that debt every quarter, and as investors would understand, that often you the EV of if the EV, all other things being equal, the EV of the company remains the same, and so that debt value will translate into equity value as we pay down that debt. So that's certainly on the cards. Cash generation. Last quarter we had two large ships that were still being loaded at the end of the month, and so the cash in bank was about 31 million at the end of the month, but that a couple of days later that was almost $60 million, and so that's the kind of, again, sort of the cash generation we're likely to see through the coming quarters if we can continue to hit those margins. Obviously, costs, we're still optimizing a little bit after the expansion. I mean, the flow sheet is less than has been running for less than a year, so as one might expect, there are still things that we're ironing out, but variability in the system and volatility in the system that we're focusing on. We're down to the sort of the small elements now. It's the 1%ers, the 2%ers, and it's those days where we get to see that volatility that we're trying to iron out. And if we just get rid of the bottom 10% of those volatile days, that adds about 400,000 tons to our output. So there's a big prize in the continuous improvement of getting rid of some of that variability in our flow sheet, and we'll continue to work on that. That's not going to require capital. It's really just about proper, sort of slightly boring but everyday focus on these sort of the continuous improvement elements. So we set a target in 2022 of $30 per ton US delivered. That we use the US number in a market sense because that's how product is priced, and we're on track to be able to deliver that in 2026. So that's good, and we should be also creeping forward somewhat on volumes. We haven't yet finished our budgeting process for next year, and we'll tell the market when we've done that. But we should expect to see a bit more output in from a volume perspective. But in terms of the market, look, the market has come down, softened a little bit since the first half of the year, but it has been relatively stable the last 4 or 5 months. What we've seen is a bit of a counterbalance between Guinea, who provides almost 75% of the volume into Asia Pacific, has continued to be quite unstable. With the coming up to elections, the government is flexing its muscles in cancelling mining licenses and putting extra taxes and royalties, and that's causing a bit of dissonance in Guinea output. So that's definitely an uncertainty factor. But on the other side, there's been a strong set of imports in the first half, so there is a bit of bauxite stock on the ground, and so customers are not feeling kind of too stressed about that yet in the short term. And unfortunately, whilst aluminium price is very high, which is great, so after the Trump tariff, I guess, shock earlier in the year, aluminium markets have continued to be recover quite strongly, and we're seeing aluminium prices that we haven't seen for probably 3 years, which is a great sign that all of that electrification and demand for aluminium through decarbonisation is still flowing really strongly through to that aluminium price. At the next level down, the alumina price is quite soft, so we've seen there's a bit of oversupply in alumina. Those are most of the customers we supply are making alumina. Some are integrated all the way through to aluminium, and those guys are pretty comfortable, but the ones who are long alumina and selling into the market are feeling the pinch a little bit from a margin perspective. So that's tended to counterbalance the uncertainty. So look, I see prices kind of trading in the current range, maybe slightly softer over the next quarter or two, whilst that stock works its way through the system. And then once we get into next year, I think that we're back to a more even supply-demand balance again. And so we might see a bit more strength there, and particularly if there's a bit of a shakeout in the alumina business. So look, we can't control that. All we can do is keep driving incremental volumes through and keep driving our costs down. And as I said, we do, one of our big strategic aims is to be the lowest cost producer in the market, and I said we're on track for that. So that's what 2026 holds for us, and as I said, being completely exposed to that market price, which is obviously structurally much higher than what it was in 2022 when we signed those fixed price contracts.
Well, there's some excellent insights there, Simon, from Metro Mining's latest quarterly report as well as global markets. So thank you so much.
Oh, it's been my pleasure. Thank you very much for having me on the show.